Hello everybody, good afternoon. Welcome to another one of our Mercatus courses. My name is Mary Ann Rodriguez, and I work for the Capital Campus team at Mercatus Center at Mercatus University. Today we're joined by Dr. Bruce Yandle for one of his quarterly updates. He is a frequent speaker with us, and he visits us 4 times a year to provide an overview of the changing conditions in our economic situation and what's been going on. So we're pleased that you are able to join us today. Just a few announcements. Coming up in the next few weeks, we have a few additional courses that we're going to be having next month. We'll be joined having some topics on HB1 visa, so an immigration issue, and we'll also be looking at the South African elections that are coming up and have some commentary on what's been going on in South Africa. Also, as a reminder, please remember to make a few notes on the blue survey sheet that we pass out. Your comments really do help us evaluate our program and give us insight and feedback on what is most valuable to you and when considering future programs that we're going to sponsor. Right now, I would like to introduce our speaker, Dr. Bruce Yandle, who is a professor emeritus at Clemson University and is also a member of the South Carolina Board of Economic Advisors. Previous to his extensive academic career, he works in the private sector in the industrial machinery business and also has some familiarity with government involvement, having worked on the President's Council of Wage and Price Stability and also for the Federal Trade Commission. So we're privileged to have him join us, and so welcome to Dr. Yandle.
Thanks so much for coming out today to hear the good news. When I left this morning, Doc said, be sure and give some good news. And I said, you really know how to put a burden on an economist in a time like this. But as we scratch around, we will be looking at some things that are looking better. And that is the good news. An old story. The gentleman at Victoria Station there in London seemed to be very agitated when he walked up to the ticket master and said, I'd like to get a ticket to Dunston. And the ticket master said, I'm sorry, sir, today is Tuesday, and the train doesn't stop at Dunston on Tuesday. He said, well, I'm really desperate to get there. Do you have any suggestion? And the ticket master said, well, let me give you a ticket to the next station past Dunston, and maybe you can find a way to get a ride back to Dunston. And that was the best he could do, so he got his ticket and hurried on and got into the car. Still appeared to be rather nervous when the conductor came along, and he said to the conductor, I'm desperate to get off in Dunston. And the conductor said, I'm sorry, sir, today is Tuesday. The train doesn't stop in Dunston. And is there any way you can help me? And he says, I've got a ticket to the next station, but I'm desperate. He said, well, sir, there's a long curve as we approach Dunston. I'll talk to the engineer. I'll ask him if he can slow down. And then as the train approaches the platform, we'll try to push you out. And you've got to run because the train will be moving. We don't want you to injure yourself. And maybe it will work. So as the train approached Dunston, sure enough, the engineer slowed down the train as they approached the platform. The conductor came, they opened some doors, they pushed the man out, and he was running down the platform, thanking his lucky stars, I've made it. It didn't fall down. The train is passing, and just at that moment, some doors open. Someone reaches and grabs him and says, you don't know how lucky you are to get on this train. It's Tuesday. And the train doesn't stop in Dunston. I think a lot of individuals, a lot of families, a lot of people, a lot of businesses are asking this question about this, what I call now the Great Recession. Is there a way to get off this train? And without being grabbed to pull back on in terms of events, actions which might perpetuate it, make it worse, or otherwise. The topic that, of course, is sort of hot today as a result of recent events, hearings taking place here in the building, front page stories now for 3 days, is AIG. I'm escorting a granddaughter around Washington on this trip, and so I was with her. She's 16, and this is one of those times when the grandparents take them on the tour. We were over at the Museum of American History the other morning, and as we walked out, a woman approached me with a mic, and there was a cameraman, and in a very crisp British accent, she said, "Sir, I'm with the BBC, and I'm asking people questions this morning. Would you mind if I interview you?" And I said, "Well, I'll try to help you if I can." She said, "I'm asking for reactions about the AIG bonuses. Would you talk with me about that?" And Dot, my wife, looked at the reporter and said, "You don't want to talk to him, he's an economist." And so she asked the question about the AIG bonuses, and as I typically do, I gave her a 20-minute answer. But I want to ask you, as you think about this issue, because it is a perplexing issue, at the same time, it is a fascinating issue, because it speaks to the times that we are in and to actions that we have taken. But let's explore the bonus question. What are the issues? Aside from the fact that there is an understandable populist, they call it populist response. Those are my kin people they're talking about when the populists say, "We don't like this." That's out there and it's big. But that doesn't get you anywhere in terms of what the policy might be with respect to the problem. What are the issues? Why is it a challenge to deal with? What's the issue here? Anybody want to speak up on this? Yes, sir. All right, so first off, you say this is a firm that's failed, big time. And what does this mean? Bonuses? Does that compute in the context? And so that's an issue. What's another issue?
That the employees got contract, but before the government gave them the lion's share of money, they didn't put a condition preceded on it saying that portion of the contract's going to be null and void. We're not going to pay bonuses for this failed behavior. You know, they just gave them the money carte blanche, and now that they're trying to say, "Oh, we want to go back," and
Okay, so let's really simplify it, very much so. My granddaughter is at the University of South Carolina. We believe in equal time in my family. She works at a very nice restaurant there in Columbia. The pay is low, but the tips are big. And she has a contract. What if you're working as a waitress in a restaurant and you work real hard and you take care of the customers and the tips are going to accumulate, but the restaurant is not well managed and it's going bankrupt? Should they honor her pay agreement at the end of payday, or do they say, "Sorry, honey, we're going bankrupt. Sorry, yeah, we made the deal, but we just haven't made as much money as we thought we should"? Tough. And so you do have contracts. But what's the issue if you don't honor the contract? Aside from the legal issue, you might get sued. What's the you might say, another issue that has to do with this firm that has been failing? What difference does it make? Is there another issue? Yes, sir.
I mean, there's a couple of things. One, you have arguably very complex transactions you're trying to unwind.
Okay.
And the best people to maybe unwind them are the people who it's loaned in the first place, or at least some of the students.
So there's an argument that, hey, this thing is failing. Do you want to hasten its failure? If you cause people who maybe have a lot of expertise to throw up their hands and say, "Hey, you whelped on the deal, I'm out of here." So there's that kind of risk. Go ahead.
I'll also, since you mentioned your granddaughter
Yes.
going into bankruptcy, if AIG wasn't bankruptcy courts all the time now for things like that.
Okay.
So you can have that avenue.
Okay. So if they had gone to bankruptcy avenue, and so now this raises another issue about when these things happen, how we manage, how we manage. There's a lot about the kind of problems we may have to later. And now we've got two other candidates that are sitting there, prominent candidates, vice president, general board, with big debates about whether it ought to be bankruptcy or some sort of arranged bankruptcy or something else. And your point is an interesting one. So So we've got a kind of dilemma. There are relative merits there. Who owns this company now, roughly? All right, we got 80% of it. We taxpayers own 80% of it. That's pretty close to saying we own it. And so then if you say, well, let's make them give the money back, who are they going to give it to? Let's give it back. So now it's back wherever that is, it's taxpayer money, they gave it back to us. And so in a sense of giving it back, then the opportunity cost may be with losing key people who might be critical to building this thing forward. So we've got these issues. It's not a simple yes and no kind of situation. I've been interested in the Washington Post editorials in the last few days on the issue, where they've raised these points that I think are raised by every organization, which is to say there are long-run, sustainable, firm issues here. Some of the contracts we're talking about, as best I can tell, I tried to get more detail on it. As best I can tell, the contracts go back to before Lehman Brothers went down the tube, before the September we fall off the edge. And so, in a sense, these contracts were back in the quote, good old days. And everything was kind of hunky-dory, and then the world starts falling apart. If the contracts had been made in the bad old days, after the crisis, then perhaps it would be a very, very different issue. And the other thing, of course, is this is a vast enterprise. It comes with a number of people. The total value of all the contracts we're talking about in the bonuses is a large number. It's a large number of people. But then there are also some very large bonuses for some key individuals. But a lot of it does go to contracts. And within organizations, you may be involved in a division of General Motors that's making a lot of money for the company. Corvette division is an example. Small division. Throws out about $1 million in positive cash flow every year out of those Corvettes. In a company that hadn't seen positive cash flow in a long time. Do you reward the executives of the Corvette division if they do even better? Those are the kinds of questions that come up as we look at the difficulties of managing a government-owned enterprise. Now, government-owned enterprises are not all that unusual. Volkswagen is still largely owned by Lower Saxony, one of the states in Germany, which goes back to its origins. They don't own 80%, they own 30%. Renault was owned by the French government. Mr. Renault was a Nazi sympathizer, and so the government nationalized that auto company and then gradually unwound it. But as we look at ownership, incentives begin to surface, and incentives matter a lot. And I think something that someone touched on, now that we encounter this, it suggests that the deal that is written up going in needs to be specified much, much more carefully. But we're talking about the outlook, and the question, will April showers bring May flowers, in the sense of, will things look better in May than they look right now? And I'm saying, well, maybe in May of 2010, that it's going to take a lot of April showers and a lot of other things for us to see brighter days in terms of some economic numbers, but there's still something for us to think about. And there's some pretty interesting data that gives us some encouragement. We know we're in a recession, and I'm reminding you of what that means. A recession means that you were at a peak of a growth cycle and started down. The recession ends when you get to the bottom, the trough. That's the end of the recession. The end of the recession doesn't mean happy times are here again. The end of the recession says you just stop sliding down the sliding board and now you can get off and walk around. And so in terms of this picture, this is about where I think we are in March. There's our turning point, which was December 2007, as specified by the National Bureau of Economic Research. And another thing that gets really interesting, how many of you remember your calculus? Grown. You remember first derivatives. First derivatives have to do with the slope of a function, for example. And the first derivative of this function says, hey, it's going downhill. It's the second derivative that gets to be interesting now, and the question is, are we going down at a faster rate or a slower rate? And so I'm showing you two tangents to the function. Now, heaven forbid, you didn't think you were going to get this one, did you? All right, I'm showing you two tangents to the function. So as we look at the tangents, we can see that the slope here is negative. It's getting flatter as we get here. And it's sort of interesting. We are at a time in the economy where we celebrate little things. And one of the things we're celebrating is the second derivative. We want that second derivative to be what? Now, I'm listening for my good calculus students. What would we like the second derivative to be that would say the recession is over? Did I hear somebody say zero? We would like for it to be zero. We would like for that line to become horizontal because that would say the recession is over. But it doesn't say happy times are here again. That's the warning now, because as we are in this time, you will be hearing a lot of comment about, well, we think the recession will be over in 3 months and things are going to get better. That doesn't say things are going to get better. It says they are not going to get any worse. All right, you're at the bottom. Now, I accumulate a lot of forecasts, and I organize them chronologically, and that is what I'm showing you here are forecasts organized chronologically so that you can see how some important forecasters have changed their view of the national economy through time. At the top of the chart are forecasts from September, and notice you see the Congressional Budget Office's forecast up there. Now, this far right column is for the year we are in. That's for 2009. The leftmost column was for 2008. And so we're interested in this column right here. And as you can see, the International Monetary Fund, Wachovia, may they rest in peace. We come on down to other forecasts. But as we come down the column, you can see that the same forecasters, or forecasters generally, have become more and more pessimistic about the economy. And I'm more pessimistic than these. That CBO forecast was on February the 25th. It's fairly current. But they were doing their forecast, as all forecasters do, without having some information that came shortly after they made their forecast. They didn't have the benefit of that piece of information right there. That piece of information, I just want to notice, for those of you who are uninitiated, these are crimson colors, all right, so we move forward. That negative column, we're looking at GDP growth. So when we're above the line, that's positive, let's all celebrate. When we are below the line, that's ugly. This column had been 4.2 in terms of negative growth. In other words, it had been up in here. Commerce Department came in with revised data. And now it's greater than 6% negative. Those forecasters did not have that piece of information. And so as I reorganize my bar chart, and this is what I think the picture will look like as we go forward, it will not be as neat as that. But as we go forward, if you were to average out the numbers that I'm showing there, it's a negative 3.5% for the year that we are in, instead of a negative 2. And it's largely because of what's expected in this quarter that we are in right now. It gives this next big negative number. But you can tell my mother loved me a lot when I was little, because you can see I'm optimistic about the shape for the future, but I'm not alone with that. Now let's look at some things that are rather interesting. I'm not going to say they're troublesome, but they represent troubled people. What I'm showing you here is savings for the entire American economy. In other words, if you take total personal income that people get, and they pay their taxes, and now they have disposable income, what are they doing with it? And what we're looking at here is the annual level of total savings for the American people in 2007, the total savings, added all up, for all of America was $50 billion. Now, I realize I'm saying this in a room that's accustomed to talking about trillions. The total savings, I will repeat, for the entire American economy in 2007 was $50 billion. Now, if that continued, and we have a $792 billion bill that's just been passed for stimulus and so forth, if we were to devote all the savings of the American people to paying that deficit, how long would it take? 50 divided into 790 billion. How many years if you said we'll just take all the savings of the American people? It's an ugly picture. But notice what has happened to savings. The American people are very bright. Now, some of us individually may not be real bright, but collectively, we're pretty bright folks. You see what happened when the rebates came, right in here? That's when Congress sent the check, said we want to send the rebates. What did the American people do with the rebates, by and large? Put it in savings. Then they cut down their savings, but they didn't come back here. And now look at what has happened. A huge explosion of savings. Now, there's not anything like that in this series. That is, you can search further and further back, I'm sure. In fact, the series did not exist long enough for us to really go back and, for example, look at the Great Depression. But somebody tell me, if you just have this piece of data about a population of people, what's your interpretation about these people? They're scared. That's fear. So we're looking at fear. Fear goes with lost trust. Lost trust generates fear. And so right now we have a population of people who've lost trust with some institutions that are critically important for economic activity to flourish. And they're fearful. Am I going to lose my job? Am I going to lose my house? I better tuck something away. And so we have this huge increase in thrift. Now that's the level. That's the percentage growth. So what I'm showing you here is way on back. Here we are, 2006. The growth rate was 0. It was going down. The American people were reducing their savings until we get the growth rates that have increased. That's a percentage, 2,500% increase on an annualized basis. And so here's fear. Now, if we wanted to look to see when are things going to start getting better, in the eyes and minds of the American people, I will be watching that number. Now, I don't have any particular interest in whether savings are going up or down. I can say savings are a good thing, or I can say you can save too much. I'm not into that issue. What I'm into right here is finding some barometer that says, hey, the American people are relaxing somewhat. They're getting more comfortable. There's some trust that is returning. The fear factor is going down. But I put these charts together 5 days ago. That was the most recent data I could get. So what I have right now says there's still a lot of disturbance out there. Now, what I'm showing you here are the recessions that have taken place, as you can see, starting back in 1960. The length of recessions, just so you'll have a feel for it. With this recession, we're at 15 months and still going. That is, we haven't found that bottom yet. And you can compare that. Here are all the recessions since 1854 to 2001. 17 months on average. 10 months on average since World War II. We're at 15. And since that gives me that nomenclature that I'm using, calling the Great Recession of this period. And so we're still going down and holding, but let's look at some other data. In a sense, so that you can appreciate the magnitude of the force, this is total employment for the American economy. This is monthly data published by the Bureau of Labor Statistics. I've run a function through it that is just a trend. So you can look below the trend and see light. If you can see light, you can say, whoops, we've got a slowing economy. And you can see 3 periods with light below the trend. And now you can see this current period. A very rapid drop-off in total employment. Still sinking, But if you want to be optimistic, those of you who are on the front row can see what's happening through these bars as it goes down. Second derivative, friends, it's not going down by the same fast clip, but it's still sinking. It's still sinking. Now, someone has done this, John Cogan out of the Hoover Institution. It helps it somewhat. As you can see, what John has done is he's gone to the turning point of previous recessions. That is, he's gone to the top of the roller coaster. And that's going to be my starting point for comparing a family of recessions to see how they compare with each other. And it will help us to understand whether what we are dealing with now is far worse, about the same, or better than others. He's looking at the rate of job loss. Here's the current one. And if this is any comfort to you, it's not as bad as the 81-82 collapse that we had. It's not as bad as that relative to the size of the economy. It's worse than that in terms of the total number of people affected. But we have a much larger economy. And so there's a little bit of encouraging news that, hey, if we weathered this in 81-82 and came back, which we did, then we have reasons to be perhaps a little more optimistic. I think if I had asked the question of you or myself to construct this graph without having seen it, I would have missed the question. I would have said that our current recession would lie below this yellow line. It's up above. One point that I try to stick into presentations, because if there's one chart that I put my hands to, if there's one chart that I could get put next to George Washington's picture in every schoolroom in America, in every high school, it would be this chart. If I could just get one thing put on the wall. This is the unemployment rate, this was for February, for American workers based on educational attainment. Never, in terms of the data history, have we had such a high return to education in America. It's at an all-time high. I don't mean in this recession. I mean before the recession. That is, in normal setting. We have an incredibly high return to education, even to high school education, as you can see, what the unemployment rate is. When you think about your state or your district, if you have unemployment rates, we have in South Carolina 18 counties that have an unemployment rate greater than 12%. We have one county that has an unemployment rate of 24.2%. We've got a range of some high and lower employment rates. It maps pretty well into educational attainment. Not perfectly, pretty well into educational attainment. And so to prepare ourselves for the next one, all that we might do to encourage this improvement. Put it on the classroom walls if that makes any difference. I saw a sort of an ugly cartoon the other day. Editorial cartoonist had a picture like that, only you could look inside the engine compartment of the car, and the cartoon has a character, perhaps coming from Washington, with jumper cables and so forth, and says, "I've come to get the engine started again." The hood goes up, and guess what's under the hood? Nothing. There is no engine under the hood. So, in this case, what I'm reminding you is that we have four tools that are now operating as we deal with this great recession. Four things working away. Very prominently, monetary policy. As Bernanke said on 60 Minutes the other night, he went ahead and said it just plain out straight: we are printing money. I've never heard a Fed chairman say those words. That is, they say it every other kind of way, but I've never heard one just say, we are printing money. And they are. They're printing a lot of money to get it out. There's a huge amount of money sitting on the sidelines. And I'm not just speaking about this increase in savings. There's a huge amount of money sitting on the sidelines in corporate accounts, in personal accounts, waiting to invest. As long as that fear factor is high and the trust factor is low, and then as uncertainty continues to come in, to the picture, and I'll mention some of those uncertainties, that money is going to be sitting there. Then we've got fiscal policy. I've made reference to the Stimulus Investment Act. That's just one of several. And so that's increasing spending. As all of you know, most of the spending in that act will occur after this recession is over. That is, it's out there 2011, perhaps 2012, when the engines really get going on those big construction projects. It can't happen quickly. And so if you're optimistic about the recession ending, then you will be optimistic that that spending is not going to help this recession. That's not to say it doesn't matter. It just doesn't help this recession. This one will be over. When is the recession over? When we're at the bottom, ready to come back up. And so it can play a factor on the trip back up, but it does not play in ending the recession. It's going to be over. So it's not anti-recessionary. It may hasten recovery. Then we've got industrial policy. Industrial policy is when government decides to get its hands into the levers of the economy, such as nationalizing AIG. That's industrial policy. So efforts to get the hands in to nationalize Freddie Mac, to nationalize Fannie Mae. That's industrial policy. And so the last thing that we have going are market forces. And market forces can be encouraged or discouraged by these other things. Right now, the unemployment rate in America is 8.1%. 8.1%. That says that 92% of the people in America who want a job have one. Just slightly less than 92% of the people who want to work have a job. There are not many economies in the world where you can make that statement ever. But 92% of the people who would like to have a job have one. Now some people talk about the glass is half full and half empty. We're talking about 8.1% versus 92 or 91.9%. That's the market forces. We've got a huge economy that is out there working away. It's just working with less capability than it could have if that unemployment rate were lower. But then we throw in the fear factors and the uncertainty and the lost trust. And so this economy that is working away, that is generating new investment, that generated an increase in housing starts, the data was released yesterday, that's the real economy that is operating out there. This is the economy made up of people where there will be 800,000 new households formed in this country this year, and those people have to live somewhere. And so you talk about excess stock of housing and apartments and so forth. You've got 800,000 new households that are going to form. That's not as a result of government policy. We can say that's market forces that are working for it. And so most likely, the most powerful salvation that we will get is going to come from that last item, because that's talking about 92% of the workforce that is out there generating something, and we're trying to soften the hardship that comes with the lost employment. Now here's some good news. The Institute for Supply Management surveys every month 2 categories of executive purchasing officials in the American economy. The first survey, which you see on the chart, is made of people in manufacturing. That's the leftmost chart. The second survey is made of people in the services sector, rightmost chart. Both surveys are based on a similar kind of index number. 50 is the magic number. When they get a number of 50, that means everything's hunky-dory. Not real good, not real bad. If the value is below 50, that says we're shrinking. Above 50, the economy is expanding. And so here's manufacturing. I put in a red line in both charts just to remind you where September lies. Because September is when our economy fell over the side of a cliff. That's when the panic started. And so you can see the effect of the panic in terms of the indices, the sharp decline in both charts. Now we get to the second derivatives. Notice we were going down, down, down until December in manufacturing. Two observations now clawing their way up from the bottom. They're not to 50, we're at a low level. The services economy is much larger than the manufacturing economy. It generates much higher incomes than the manufacturing economy. So here's the more important of the two charts in terms of their economic impact. Notice that the services economy dropped off the cliff there between September and October. It got worse, began to get better, picking up, down a little bit. Indication that you're searching for a bottom here. Let's see if we can find some more good news. Here's retail sales. That's retail sales. That's including retail sales with automobiles. And so with retail sales, you see a bar that suddenly shoots up, down just a little bit, but that's including automobiles. If you take automobiles out, it's up almost everywhere. Here's existing home sales. That one has bounced up and bounced back down. Every quarter, the Federal Reserve Board takes a survey of credit officers of banks nationwide, and among the questions they ask, are you tightening your lending standards or are you relaxing? That's this chart right here. Going back to 2007, tighten, 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 getting some relaxation. Why aren't banks lending? Why do you think they aren't lending? The word, that's the word. The data say they are lending, but not at a very high level. Why do you suppose they're not lending? Anybody talk to a banker recently to ask why they're not lending? My conversations with bankers, and this isn't a large sample, maybe 15 or 20 I've spoken with in the last few months. Typically they say we're not lending because there's nobody coming trying to borrow. Think back about the savings chart and figure. You can't lend unless there's a line there in front of the loan window, so to speak. And then the other part of their answer is, and those that come, I would have a hard time qualifying. And so they have two problems right now. One is the fear, lost trust, and then people who would not qualify at a time when the banks are being held to a higher standard of creditworthiness by the regulators because of the problem. Now here's vehicle sales through February. It's been sort of interesting because I've heard some important speeches that have come out of Washington by some of my friends and political leaders saying, why on earth aren't American people buying automobiles? Well, we've got the parking. They're saving. There's another piece. Until the day that that stimulus package was passed, included as a potential element in it was what? That had to do with automobiles. Anybody remember? Credit. A tax credit. How much? $8,000 tax credit if you buy a new automobile. Now, do you remember the day the piece of legislation passed on the Hill approximately? What day was that? The date, approximately. Anybody remember? It was February, right? Late February. We're looking at data through February. Now here I am, I'm this average, I'm talking about an average American, smarter than I am. I'm this average American out here thinking about buying an automobile. They've really cut the prices on them, but then I read that the politicians in Washington might send me $8,500 off my tax return if I buy one. Do you think I'm going to rush out and buy a new automobile? No. That's the uncertainty that is generated by the fiscal policy. Now, why would I ever believe that Santa Claus would deliver that $8,500 to me? Because they did it in Germany and they did it in France. And say, well, gee whiz, if it happened over there, something like that might happen here. Over in Germany, you had to trade in an old clunker. That was part of it. Trade in an old clunker, get a new, fuel-efficient, clean car, get a big deduction off of your income tax. And so that kind of uncertainty causes the investor to sit on the sidelines with the money. That uncertainty is gone. So the forecast would be other things equal, as my son says, they never are, Dad. Other things equal, we would expect that bar to turn up because that piece of uncertainty has been removed. This data came out yesterday. That's industrial production. Industrial production, that's all of the output of the mines, the public utilities, and manufacturing plants in America. We're looking at the growth rate. You can see where the zero line is. We're down in negative territory, but what's the good news? It's headed towards zero. All right? It's not getting more negative. It's headed up. And so here are factory orders. What's the good news? They're below zero, but headed towards zero. As we look at a number of series, we're seeing things that are pointing towards some improvement. And here's maybe the last one that I will show you that falls into that category. The Bureau of Labor Statistics maintains what they call a diffusion index, and this has to do with the unemployment rate as measured across 271 industries in America. That is, how widespread is the loss of employment. When we are at 50, it's even. Same number of industries are gaining as losing. It's where we are now. 2 observations, getting better, bless his heart, still hunting for zero as we go forward. Let's look at housing markets and see if we can find some more good news. The data I'm showing you here is a tracking of 20 metropolitan statistical areas in America, index on the price of houses sold. I'm showing you data that goes back to 2000, and I'm coming forward to, I believe this is August of 2008. As you look at this, you are now seeing the housing bubble. If you ever want to know what does the housing bubble look like, you got it. You see the housing bubble. Where was it inflated the most as far as you look as far as this data? Phoenix, Arizona. And next most, Los Angeles, California. And next most, San Diego. And no inflation at all, that's Detroit, Michigan. There is no bubble in Detroit. I don't know what the opposite of a bubble is, but they got the opposite of a bubble. Average prices are falling, not rising. The same thing in Cleveland. If you had Charlotte, North Carolina on here, there's no bubble. And so for about half of the cities, there is no bubble. But then the cities that have a bubble, it's pretty powerful stuff. Now, what's the interesting news? The interesting news is as you follow these threads, they are deflating. Now, there's an expectation that you would not expect the threads to finally come back to the starting point. After all, there are other kinds of forces that would affect the average prices of new homes sold. But as those threads come down towards zero, supply and demand are coming back into balance as homes are being sold because of the cut prices that are happening in those areas. And so, well, Charlotte is over here. I see Charlotte's here. That's Charlotte right there. Hardly any change. Now, where the bubbles were biggest, the default rates were highest. That's all this chart is showing, except for one area. There was a high market default rate, you can see, is in the hottest real estate markets in America, Arizona, Nevada, and California. Then down in Florida and a little bit of Georgia, Atlanta primarily. But then we've got this area up at the top where there's a high default rate that has nothing whatsoever to do with subprime or anything else. It's a declining region, and it's tough. Someone, I guess it was an economist at one of the major regional banks, was telling me that the price of the average home sold in Detroit, the city of Detroit, last month was $7,000. That's a distressed real estate market. Down my way, they call those Visa houses. You can buy them on your Visa card. $7,000. So there are not a lot of folks trying to buy a house in that particular market. This is where the default rates are highest. And now this is showing you where foreclosures are highly concentrated. This is March data. Just another rendering of the same thing. Obviously, the policy that might be adopted to deal with the problems in those two severely hit areas are quite different from the policies you would adopt to try to deal with Michigan, Northern Ohio, and Indiana, and dealing with their problems. I'm showing you now how this recession spread. The data that you see in the leftmost map, the darker the color, the higher the unemployment rate. That's March of 2008. This is the most recent data from BLS, that's January. And so you can see how a recession that started over on one side of our country began to spread. There's one golden state left, still generating wealth at a pretty good clip. The other states that are in the ethanol, gas, oil, coal fields are doing relatively better. But everything east of the Mississippi has just about hit the peak of the recession problem. Only it's going to get worse in those states as we get more data. And that is for January. We have 4 states in America now that have an unemployment rate that is exceeding 10%. South Carolina is the second most. Michigan is number 1. South Carolina, Rhode Island, and California. Those are the high unemployment states right now, and those numbers will get worse as we move forward. There's a tendency for unemployment to continue to expand even as we get to the end of the recession and we're clawing along. Recovery of employment comes after the recovery of the economy. Let me just show you this. Someone who tracks recessions for countries of the world. There are 2 countries in the world now that are considered not to be in a recession. Somebody who knows their geography real well and can see the green in this chart. It's hard to see. I've got an arrow pointing to it. There are 2 countries that have an expanding economy right now that is expanding at a normal pace, Colombia and Ecuador. Those are the only 2. What do you suppose their major industry is? Drugs, right. So they're shipping out drugs and we're shipping them guns. And so those are 2 important industries as far as generating income is concerned. And so only 2 countries now in the world. And to me, this is one of the most incredible things that I have encountered in my lifetime in terms of study of economics or study of anything. Now, something that could have started in a little corner of the United States, big economy, but little corner of our country, could be spread to the entire world in a relatively short time. To me, that is truly astounding that it has happened this way. And it speaks to a number of things. One is connectivity. The world is connected. It's connected in lots of ways, and one of the major ways are the financial circuits that are present. So that investors in Helsinki or in Dubai would be buying financial packages that contain in them pieces of mortgages from Anderson, South Carolina. Do they care where Anderson, South Carolina is? They probably couldn't point to a map and tell you where it is. But inside those bundles of financial instruments were slices of mortgages from homes from all across America. And some of them were subprime mortgages. But there was enough prime stuff in the package for our major credit rating agencies to label the package AAA. And that's all that investor needed to know. It was AAA by Moody's, by Standard & Poor's, or by Fitch, and that was good enough because that's as good as it gets. So what's incredible is that stuff could be packaged, and now we know mislabeled, but nonetheless labeled, so that investors unwittingly put this stuff on their balance sheets. And then when the pieces of paper went with negative cash flow, they thought, what does AAA mean? And when they thought, what does AAA mean? What about the rest of the stuff we have here at AAA? And what about the bank across the street that we normally lend to or borrow from? They've got AAA stuff. And that's lost trust. It leads to the collapse of the financial markets. Now, a little bit of a pessimistic note, but this is a risk that is out there, so that you'll be aware of it. Don't worry about the details on these bars, just really celebrate how tall they are. What we're looking at over here on this axis are billions of dollars. This is billions of mortgages which have in them an adjustable rate, a trigger that will cause the mortgage payments to change. And the time period during which those changes can take place go out to 2012. And now you see the magnitude of it. And you see the end of the magnitude. All that we're looking at here is a high risk. If the Fed and others are unable to keep interest rates low, and interest rates rise, and these things reprice, we'll get another wave of foreclosures and difficulties. At the end of our last gathering, we had three options. None of them turned out to be real neat as far as fitting data. You have in front of you three options for this time, but we had three choices when we were together in, I guess it was December or maybe early January. And this shows you how the group voted in picking between the three. There were a couple of people who asked me if they couldn't write another choice, and that would be a fair thing to do, or modify one. And I would love to see that if you want to scratch through and add something. But 26 people said 3 months from now, which is about now in March, or into March, bailout interest rate cuts weaken the dollar, crude oil rises to $60 a barrel, not quite. The Dow sinks to 8,500, got worse than that. Interest rates on 30-year fixed rate mortgages rise to 5, no, they haven't gone that high. More failing banks get merged with big guys, unemployment hits 8.2, no, it hit 8.1. So, but 26 of the people in the room picked that one. You can see how it compares to the other two. Nobody picked this one. We didn't have any raving optimists that day. But let me ask you, if you would please, to take a look at these three and pick what you consider to be a winner. We're talking about the Mayflowers again, in number one. But if you will, look at that. And while you're looking and picking, we've got about 4 minutes here before the witching hour of 1, and I know your time is precious, and some of you may need to slip out right now. Please do. But do we have any questions? Have I touched on something?
Just a quick reminder, I'm sorry, if everyone can remember to fill out those blue sheets. Also, while you're looking at Dr. Yandle surveys, and wait for the microphone, and we'll have you yes,
Good. Fill out the blue sheets, please, the evaluation. Yes, sir.
Where you were talking about the savings rates were going up on the population, is that also, are you including in on the savings rates, people paying down debt as
Yes,
well?
that would be,
It's a combination.
that's right, that would be paying down.
Is the one online, or?
That's right.
This one is in.
Any other questions?
I'll email it.
Thanks very much. Any other questions? While we are plugging things, the blue form, the evaluation is very important to us. I wanted to remind you that should you wish to access it, I do a quarterly report on the economy. It's posted on the Mercatus website. And that one that is there was turned out the first week in March. It's got a lot of the same detail. Only what we're seeing in here is a little bit fresher than what's in that report. But should you wish to access that report there. Any other questions? Thank you so much for being here today. And if you would fill out the forms and leave them on your table, we would appreciate it.
Thank you very much. If you guys could join me, thank you very much. Thank you very much, and please keep track of the website. You see that we have all the project listed, description, city, state, jobs, estimated, cost of project, program type, and vote ratio. I'm going to sort by vote ratio. You can sort by any of these. So I want to see the most accurate. So at the very top, we see the Cincinnati streetcar network. Is the most active, right? There is a vote ratio of 525. So let's click on Cincinnati streetcar network and see that page. So the first thing you can do when you come here is that you can vote. Is this project critical? Yes or no? Right? And we don't play what criteria to use. choose for yourself. And so we see that 3,141 votes have been cast on this page. We've had, the first month we've only had it up for about a month. We've had about 2 million unique visitors coming to visit this. So over 3,000 folks have voted. The vote ratio is about 42% in favor, 58% against. So that's the first thing you can do. The second thing you can do is that there's a wiki that you can edit. And when this page started about a month ago, it was empty. There was nothing there. All it said had headers. It said general description, it said points in favor and points against, and it was empty. Citizens come here and they add local knowledge. I have no idea what the Cincinnati Street Card Network is. Folks in Cincinnati do, and are very passionate about it. So they have added all this information. When you see up there at the right, it says edit. Anybody can come here, click edit, and add the fixed information here. So they have added general description for the project, points in favor, points against, and then further reading, links. So folks have created these. We can do this. We just put up a place. And the third thing you can do is that you can comment. And this is just a place where you can discuss and debate. In the wiki, we ask that the information posted be factual and it be from a neutral point of view. Just tell us, what is the description of this project? What are some points in favor, some points against? In a neutral point of view. If you want to have a real discussion and debate and say this is the worst idea ever, or this is awesome, you do that in the comments. Right? And so we see that 176 comments out of the post. Right? So that's what's possible when we made raw data available. In this case, the U.S. Conference of Mayors gave us some data we were able to use. We want to build a Stimulus Watch 2.0 that displays projects that are actually funded, right? And so once the recovery.gov site gets going, and I'm not going to have time to talk about this now, but please come see my testimony on Thursday for the House Oversight Committee, where I'll be talking exactly what's missing right now from recovery.gov. I guess there's nothing there now, but what can the folks running recovery.gov, what can they do to help the big community of folks who want to build tools like this to get ready for it? So you want to build this. You want to build a Stimulus Watch 2.0 where you actually find a project that is going on in your community, and where you can see every contract related to that project, right? And so if you've got a wiki, you've got a comment section, you have local knowledge, you can say, oh, wait a minute. Okay, so this is a bridge that's being built, and I see that it's going to Acme. Let's say that one of the contracts is for concrete, and it's going to Acme Concrete, and I know that this is a firm that's owned by the mayor's son-in-law. I can note it here. Right? This may or may not be useful, right? But when we sort, when we come up here, we also would like to have some sort of voting mechanism. I'm not sure what the question is going to be yet. It might be something like, are you satisfied with this project, yes or no? But when you sort, let's look at least critical, because it's more fun than most. Most critical is just a lot of boring projects. It's not very fun. When you look at least critical, you see some amazing stuff, like golf courses, dog parks, that goes on money. Well, in 2.0, when we're actually looking at money, the way it's being spent, this might be a way to flag some information that IGs around the country can use, right? They investigate do further investigation. So we want to build that, but we need real data. We need it timely fashion, and we need it in a structured format. So I'll stop there. Thank you very much.
All right, well, thank you all for coming. Well, let's thank our panelists for spending some time. We'll have a few minutes for some questions. If you want to stay, please just speak up so everyone in the room can hear your question. I'm sure there's a lot of good ones out there. And also, before you leave, if you could just fill out our survey and take a moment to do that, it would be greatly appreciated.
Oh, yeah. Going back to the countries